Good morning, guys. I think everyone can hear me. Give me a thumbs up if you can hear me. Everybody. Don't see anything coming through. I got Chris. All right, well, we'll go ahead and get started. I'm not going to take up too much of anybody's time, but we have Chris Anderson, Andre, Paige, David. I'm missing one other one in my head right now. I'm sorry.
Right?
But,
You got it.
but here with National Mortgage Bankers Association. This is our third webinar, I believe. So we're happy to have you guys on. We're going to hit on secondary marketing, and I'm going to go ahead and hand it over to David. But first, if you have any interest in joining National Mortgage Bankers and you're not already a member, please reach out to me, Tiffany Wright, anyone like that, and we can help you get signed up. So David, I'll go ahead and hand it over to you.
And thank you so much, Casey, and I appreciate the opportunity. And you reached out to do something like this for the association. I thought, no one could do it better than MCT. MCT is has some of the brightest minds in the country when it comes to this stuff. So instead of me, doing this, I thought it would be best to put some of those bright minds in front of you all and step aside. But please allow me to introduce Chris Anderson. Some of you may know Chris. He's the Chief Administrative Officer for MCT, which is Mortgage Capital Trading, hedge advisory firm, and one of the best in the country. So, Chris, I'll kick it over to you.
David, thank you so much. And David is being, of course, humble as always. He is one of those bright minds in the industry, and I'm very excited for the opportunity to speak with all of you today. I think we were having a few technical issues here, so I don't know if Andre Polisel and Paige Woodall, who are one of our senior traders and one of our regional sales directors, are able to hop on or not, but in looking at this list of attendees, I am very excited to see there's a diverse group of folks. And one of the things that really excites me is, of course, hey, it's wonderful to see, several of our clients on board, several folks from capital markets. But what's really exciting for me is to see that we've got underwriters and quite a few originators on. And I think it's just awesome that you guys are taking the opportunity to learn a little bit more about the secondary market and capital markets in general. So I'll just go ahead and start sharing my screen here. And I don't think we've been able to get our other guys on, so you might just be stuck with me. But the good thing is I love the sound of my own voice, so we're going to be all right. So I'm going to encourage everybody, to ask questions. David and Casey and Caitlin will all be watching for the questions, and I just want you to interrupt me. We can slow down, go through anything. We've got a massive slide deck that we have no intention of going all the way through. But we've got some great minds here. I'm tempted to get Amy Creason, who, ran capital markets for years and years and was with Freddie Mac and is now part of a wonderful organization called Capital W that MCT is a proud sponsor of, that's encouraging more participation from women in secondary markets, which is absolutely wonderful. And I'm going to be expecting some good questions from you, Amy, as well as I see, my buddy Alex Garner on here, and there's just a lot of good folks on the line here. And I see Nick from Primis here. So we've got a great ecosystem of folks on the line. And as David mentioned, MCT is, not that you could tell I possibly work from MCT. Boy, I'm got a triangle of MCT around me, I just realized. MCT is what's called a hedge advisory firm, but we're also a provider of software and services in the capital markets arena in general. But one of the things that we pride ourselves on is secondary and capital can seem a little bit opaque to some of the members in the loan manufacturing process, right? We're all working as a team, and sometimes folks don't necessarily really understand where capital markets might fit in. An organization might have 1,000 loan officers, hundreds of underwriters, lots of processors, and maybe 2 or 3 or 4 guys, the most, back in some dark room somewhere running capital markets. But the impact they have on the company's ability to originate loans through, working on your pricing, managing investor relations, doing all of those things that really, make the company competitive, particularly in the front end origination space, are really important. So again, I'm thrilled that we see folks all the way from originators, processors, underwriters, kind of all of the steps of the loan manufacturing process here. So with that, I tried desperately to vamp for my guys. It doesn't look like they're going to get on here, so I guess we just forget them. And I am going to, let's see if I can get this PowerPoint up here just right. Oh, there's Paige jumping in right now. So I'll go ahead and introduce these guys just in case. But David, do you mind giving me a heads up here that you can see my screen okay, sir?
I can see your screen.
Look at that. This beautiful San Diego. I am not in San Diego. Our corporate headquarters are down in San Diego. I'm up in Northern California. Andre, who will be joining, actually has a home outside of Franklin, Tennessee. So we've got folks there, and Paige is down in Atlanta. So just kind of an overview here. I'll walk through the introductions. We'll talk a little bit about MCT in more detail, but what we really want to talk about is helping anybody understand the secondary market. And again, I know we've got folks here that are, executive VP of capital markets. Some of this is going to be rudimentary. And actually what I'd love to have from the folks that run capital markets or are in capital markets or secondary now, feel free to, if you hear questions being asked that you want to make an answer to, just type all of that in, and we'll try to recognize that. So I think we can really make this be, a much more collaborative conversation here. So as Dave mentioned, I'm our Chief Administrative Officer, and boy, that's a lot of Chris Anderson face. But basically, I've been with MCT for several years, and one of the things that I really enjoy is my role in working with the different regional MBAs and being able to talk to folks like this. I run our outsourced lock desk division, our data integration services team, our IT team, business and contract administration, compliance, vendor management, and also our product and pricing team. And then I sit on our what we call our hedge onboarding team. So whenever we onboard new hedging clients, we always have a member of the C-suite, and it's usually I'm usually able to facilitate that. And if it's not me, it's another member of our executive management team, because we feel like when we're onboarding folks, that's the most important opportunity for us to kind of get it right. And so we really like to encourage executive level participation in there. And I believe now we have Andre Polisel, who is on. And Andre, I think you're just going to be made a presenter here shortly, and you should be able to speak. But Andre's been with MCT since 2009. He heads up a team of 5 analysts, and he really works on a lot more of our larger bank-oriented, larger production clients. He's primarily working with a lot of clients in the Southeast area, but again, we've got about 275 hedging clients, so that spreads our teams a little bit around. And I think Andre, if you're on now, maybe you can give us a wave here.
Sure. How's everybody doing?
There we go. We've got it. All right,
here.
Andre. And Andre went to San Diego State, which is almost like UC San Diego, just not as good, Andre. Sorry, bud. Of course, don't talk about athletics, because then
Sure.
That's where my argument ends immediately. Paige Woodall is one of our regional sales directors and a vice president of sales. He's been in the industry since, 2002, and still looks so young and handsome. Can't believe it. But he was on the correspondent side as a rep in a bunch of different, PHH, then Mr. Cooper, Texas Capital Bank. So he's had a lot of experience in the industry, whereas Andre and I are more homegrown MCT talent. One of the great things about MCT is we've been able to attract, awesome collaborators and team members like Paige. And Paige, if we got you on, did you want to say hello there, sir?
Hey, good morning. Finally.
All right.
Took a while.
Look,
Thanks, Caitlin.
Yeah, and And yes, we do have a fintech, but don't ask us to run teams. That can get difficult for us. We're not all perfect here. But so look, I don't. This is not meant at all to be a sales pitch, so I don't want to try to stuff this down your throat. But again, we've got some clients on the line. But what I want to talk about just briefly on MCT is our perspective. We've got a unique, privileged perspective of having. Like I said, I think 275 active hedge accounts across our whole company. It's something like 350 unique accounts that might be using any of these services that we offer. But what I really enjoy is looking at the, kind of the makeup of that client base. So I was just looking at these numbers, and we're 31% depositories and credit unions. I noticed there were several folks from some credit unions attending, and credit unions have been hesitant to get into the hedging space. And what we're seeing is over the last several years, there's been a migration amongst the credit union community to start getting a little more comfortable with the inherent risks that come along with hedging, although we do everything we can to minimize them. And we'll be talking about what those are a little bit. The credit unions are starting to recognize that there is an ability to increase profit I know you guys have different charters, but increase the amount of revenue driven by the mortgage lending divisions and therefore provide a better product to your members. So that's something that's been an exciting sort of thing to watch. But we've got folks that are, small community banks or credit unions that are originating, 5 to 10 million in loans a month. And then we've got some of the largest lenders in the country that are originating still billions of dollars a month, and sort of everything in between. And like I said, we've got credit unions, we've got depositories and IMBs, we've got aggregators, we have publicly held companies, privately held companies. So we really enjoy this privileged position of seeing a great ecosystem of clients. And what that does is gives us a very strong perspective on what's going on. MCT has around 25 traders. I should know that number exactly, and I'm forgetting right now. But those are guys day in, day out for our managed services clients that are working with all of the broker dealers. They're reviewing all of the financial news. They're really keyed into what investors are paying for loans and what TBAs are trading for. And Andre's a great example of that. So he's gonna, I think Andre, for example, sits over about 50 accounts with 5 analysts and himself, and then we have other groups that support those efforts as well, our client success group, data integrations, product and pricing, all of that sort of stuff. But while we are a technology company, we've never gotten away from the fact that service must be a core element of what we provide. And whoever you're using, if you're using a hedge advisor, just encourage you to take advantage of the service level there to make sure that you're not just using software, but you're gaining the perspective that these guys all are seeing with all of the client base they have here. So enough of that, felt salesy to me. So you've had to hear me talk too darn much. And so I'll toss this up and I'll give Paige or Andre a chance to jump in on just an overview here. Paige, do you want to maybe kind of talk through just an overview and have Andre jump into the more detailed stuff, sir?
Yeah, I'll cover these first few slides. Like you said, there's a lot of people with high-level secondary market experience, so forgive me if this is a little basic, but the secondary market is really to provide liquidity in the market and keep originations. It plays a key role in originations. And then basically the market is where lenders and investors buy and sell loans. And ultimately the loans get securitized into mortgage-backed securities, which are then invested in by various investors all over the world. So it really is a critical piece to creating liquidity in the market and more borrower power.
Yeah, that's a great point, Paige. And when we kind of think about, I never really thought of there being a primary market before I got into mortgage and really understood that me going in and meeting with a mortgage advisor or a loan officer or a broker, the first time I bought a home, I didn't realize that I wasn't really getting a mortgage with that broker. And in fact, that the day I locked my loan, that loan was maybe being committed already on a best efforts basis to another investor, and I'd be getting a goodbye letter at some point. So if you think of that primary market being the experience between the origination staff and the borrowers, then your secondary market, and these are so important key elements. You can't really have one without the other. And so I love, again, all of you folks from that sort of primary market experience taking an interest and participating in today's presentation here. And I think I vamped long enough for Paige to get a drink of water there. So now I'm going to go ahead and move slides here. And Paige, again, you can feel free to just have me move around. You just tell me when to drive. Sir.
Yeah, and so the key players here, lot desk staff, secondary markets, capital market staff, the investors, GSEs. One thing that's probably missing is warehouse lenders for IMBs. I mean, that's an important piece because without them, there's no lines of credit to make the loan. So
yeah, I think that's a great point there. And then, so do you want to jump into just the general how secondary mortgage market works here, Paige, or would you like Andre to jump in? You got it?
Yeah, just real quick. Chris mentioned the primary market. That's where, the originators working with the home buyer to obtain the mortgage. Once that rate is locked in, then the fun part happens, the processing, underwriting, and then the closing of the loan. And so when the loans close, the lenders can either hold the loan in portfolio, or they can choose to sell it in the secondary market. Now, whether they're selling to aggregators like some of the big ones, Penny, AmeriHome, Chase, whomever, ultimately those get sold on to the GSEs, Fannie, Freddie, or Ginnie Mae. And then those loans are pooled and securitized. And as I mentioned before, ultimately created into mortgage-backed securities, which investors will buy into.
That's excellent, sir. And just a reminder, if anybody has questions, feel free to just type them in, and we'll all kind of keep an eye out for them. But I think, Paige, you want to walk us through the two kind of primary commitment types there are, right?
Sure. So best effort, I think of best effort and mandatory as macro and micro. Best effort is going to be more of a macro pricing in which the investor is putting out a price to all their customers. And then you as the lender are agreeing to a specific rate and term, and in good faith, you're going to deliver that loan to the investor. Now, if the loan doesn't close for any reason, there's no financial implications to you, the lender. It's the simplest form of communication or commitment available because it is more macro. You're going to not get the best pricing execution via best effort. And then in this situation, the investor assumes almost all the risk. The only risk with this is the time that you commit the rate to the borrower until it gets locked in to the investor. It's also very, Chris can attest to this, running our lock desk, but it's very time consumer and labor intensive in having to make all the updates that may transpire during the
Yeah, one of the things too, I mean, what Paige just went over is 100% right, generally speaking. That generally speaking, best efforts pricing isn't going to pay up the same as a mandatory delivery, and Andre's going to walk us through all of those delivery options. One of the things that we've seen over the last few years, though, is that capital markets plays an even more important role in kind of creating pricing on behalf of the company. So sometimes you may build your own pricing, and you'll see that you'll have a premium house rate sheet, because that's where your capital markets team has the most control of the outcome, and they can, kind of manage the risk associated with that pricing, because you used to not have that much volatility in the best efforts pricing market. But as the investor landscape has become more and more competitive, and investor appetites have changed over times, you'll actually see sometimes where an investor may very well need to fill some sort of commitment for maybe for one of those pools that Paige was talking about. So you might have one investor priced way out of the market when you're looking at all of your best effort options. You may see that you've got one investor, you know, a PennyMac or a AmeriHome or a Chris Anderson Mortgage Bank, who needs to fill some sort of commitment of loans. And so they're paying up. So occasionally your capital markets team has to be, you know, monitoring for that arbitrage opportunity. And the way, you know, a lot of folks will do that is they'll create a hedged rate sheet. And then so everything that prices to that is going to the hedged rate sheet. But if a best effort investor is priced through that for some reason, that's an opportunity for your lock desk to identify that loan under capital markets guidance and actually lock it on a best efforts basis. So again, 99% of the time, you're always going to get paid up more for a closed loan, committing it on a short-term mandatory basis through a bulk commitment, a mandatory rate sheet, AOT, DT, these different models. But that is just something that we've seen more and more in the market. And so for some of you folks that are in capital markets, if you aren't looking at that, we've just seen that happen enough. So talk to your lock desks, take a look at, you know, are you seeing loans that have a benchmark best effort price that just seems kind of disconnected from your back end mandatory price? And that usually, when you do the deep kind of forensic analysis and look back, you'll see that on whatever the day the original loan was locked, for whatever reason, that aggregator that was being priced on the front end just happened to be paying up for some sort of appetite they have. Oh boy, that's exciting stuff, isn't it, Paige? Am I putting everybody to sleep yet?
No, it's good. Chris, just one thing to add to that. You know, there is no required compensation if the loan does not close and not delivered. However, I just want to always like to add this. If the loan closes and you deliver to another investor, everybody typically these days is running a MERS, and they're going to hit you most likely with a payoff fee because they incurred all the risk and all the risk and cost associated with that hedge on that loan.
Yeah, and I mean, that's a great way to think of it too, right? Under the best efforts commitment, the investor needs to pay for hedging the loan themselves. So instead of, you know, what we help clients at MCT do is instead of letting the investor, the aggregator, pay for that hedge and reap the benefits of the mandatory price, we help you fill that sort of role. And there's a lot of great hedge advisors in the space, and you know, any one of them are going to tell you kind of all the basics here, but none of them have me, Paige, and Andre. So you know, that's something to kind of keep in mind out there too. How about walking us through mandatory commitments here? And I know. I'm just going to give us a time check here. I know that we want to have an open, collaborative conversation with everybody, make sure that folks have time for questions. So we'll try to target, you know, another 15, 20 minutes or so. So we won't go through our entire presentation, everybody, but we may jump around a little bit. Sorry, Paige, go ahead.
Yeah, no, real quick, mandatory, like best effort, the lender is agreeing with the investor to deliver a specific loan or dollar amount under specific rate and term. However, in this instance, any loss associated by not delivering that loan to the investor, the lender is responsible to pay the market movement cost or the payoff fees. But since the lender, mortgage bankers, willing to assume all the interest rate risk associated, there's the risk reward. And so the primary reason people move to mandatory is for the additional pickup in pricing. As Chris said, it doesn't always work out like that, but we see over the long haul a significant pickup over best effort pricing. And so think of this as more of a micro approach. They're bidding on a loan that's already closed. They're not having to take any pull-through risk. All of that lies within the mortgage banker's desk. So.
100% right. And then maybe I'll pull Andre in here if you don't mind, Paige. Or does that sound good? Let's give poor Paige a rest here. Andre, do you want to just talk us through the type of execution types and explain why we're also calling them delivery instruments here?
Sure. Thanks, Chris, and nice seeing everybody here. I see a couple clients on here as well, so it's always nice to see familiar faces. And so this is going to be review for a lot of you, but these are some of the basic ways to be able to deliver loans as far as execution types. Nice little matrix here to provide you some of the pros and cons. We talked about best efforts, very straightforward, not as flexible. Pricing typically isn't as high. And you start moving down to the mandatory or direct, or nowadays is primarily bulk, where you're sending out a list of loans that are closed to your approved investors, and they're going to put a loan level bid price on each and every one of those loans. You can then run a best execution analysis to be able to see where your best pricing is across all these various outlets. That's really the most important thing when we're looking at various execution types, is you want to be able to leverage everything at your disposal to be able to really achieve best execution. So as we move down the list here, we have clients that are approved with the agencies, Fannie, Freddie. We also utilize a lot of assignment of trade, that is AOT. And essentially what you're doing is you're taking that TBA price that you're using to hedge those corresponding loans. You're going to take that TBA security level and essentially stick that pricing into the value of the loan. And what that's going to do is going to mitigate some of the bid-ask spread by trying to get out of that corresponding security to pare down your overall position. Now, that's a lot for someone who hasn't kind of gone through the process yet, but it's actually much simpler than it sounds. Our clients utilize this daily whenever they're doing a loan sale. And we've made it very easy at MCT to be able to take the workload out of it. We make it a very simple click of a button. You can easily see all your available trades, push that into the loan. Investor gets the tri-party agreement, which then transfers the trade from the dealer over to the investor. Makes it very easy for the end user there as far as the clients. And we also utilize some MDS forwards as well. I know builder forwards is a very hot topic of conversation, something we've been hearing a lot about the last couple of the years, right? We're trying to drum up new business. Our clients are finding new ways to essentially keep the lights on here, maybe get a little creative to drum up some more of that business. And we're going to talk more on some corresponding slides here as far as the overall outlook on the economy, on the mortgage industry. So Chris, if you wouldn't mind flipping over to the next slide here.
Yeah, one thing I just wanted to share too, Andre, makes a great point. I think one of the things that we've always used as a guiding principle for our business is hedge advisory firms used to sort of just focus on your TBA trading and would maybe handle some agency execution. Best execution really has evolved, where now you have to look at absolutely every execution available to you, because every dollar counts. Because in so many cases we are just looking to keep in business. It's tougher times these days. But thanks for reviewing that. And then I want to make the most of our time here. So what do you want to just give kind of like a quick overview of just how hedging, maybe through this slide and next, with kind of the positions and explaining the TBA, and then maybe we can jump into some more of the forecast information?
Sure. We don't need to draw this out too much here. I mean, I really want to touch on, when we're talking about mandatory execution relative to best efforts execution, you might be asking yourself, well, I understand that there's an inherent risk that you're taking on by having to hedge that loan for the duration of the lock term, but why is mandatory pricing better, right? And it really comes down to the principle of time value money, which essentially states that $1 today is going to be worth more than $1 tomorrow, right? So when you view it through that lens, and you factor in the fact that you're having to take on that risk as far as the market movement that's going to transpire throughout the duration of that lock. So if we're talking about a 30-day lock duration, the day one, the moment that you are now submitting that lock to the borrower, they're saying, hey, we're going to lock this loan in right here now. You, the client, have an option of either selling that loan directly on a best efforts basis and essentially washing your hands of any interest rate risk and market movement, or you can hold on to that lock and have your hedge provider put on a TBA short position to be able to make up for the long position of the loan. So if you're just thinking about a long position is essentially when you're buying a security, right? So if we're talking about our 401ks or whatnot, you're investing in the stock market, you're typically taking a long position, which means that asset is going to grow over time should the market rally, right? Now, in order to hedge that position, a hedge is essentially taking the opposite position to be able to hedge your longs, right? So a TBA, a to be announced mortgage-backed security, which is the most common way to be able to hedge mortgages, we're going to be selling that position. We're going to be selling that TBA position, which is going to hedge our long position in the form of the loans. And over that 30-day period, even if the market does this, your value of your long position, which is your loan, relative to your short position, the TBA, is going to move inversely, right? So if the market rallies, which means rates are going lower, you're going to see your long position, as in the loan, is going to increase in value. Your short position on the TBA is going to decrease in value, right? Same thing, we're talking about the market decreasing, market getting worse, rates are going higher. Your loan is going to be losing value, but your trade is going to be increasing value. That spread is essentially going to be what you're making over your best efforts or your potential best efforts execution. So what we encourage our clients to do is to benchmark that base best efforts price. So it's what you could have made on that loan if you delivered it on a best efforts basis right out the gate, as soon as you offered that lock to the borrower. And instead of locking it in best efforts, you're going to hedge it. And then at the end of the duration of the lock, once that loan is funded, we're going to send that loan out to all of your investor outlets, whether that be mandatory, bulk. We'll even throw best efforts just in case there's an anomaly and they're pricing more heavily on best efforts that day. Run a best execution, and then we're going to execute to the highest price. And then as soon as we go ahead and offlay that loan and that corresponding risk over to the investor, now we no longer need that TBA position. Now we can either assign that position if we have a similar TBA that corresponds to that underlying loan, and we can assign that position. So it's a one-to-one transaction. Don't have to worry about pairing out of the TBA. If we don't have the ability to assign that trade, then we're essentially just going to pare down that position. So we're going to go back to our broker dealers and we're going to buy back that short position that we sold 30 days prior. And that will essentially clean out that position between your long and your short. So that's generally, in a very simplistic, quick approach on how TBA hedging works and why mandatory delivery is generally going to yield a higher premium than a best efforts execution price.
Yeah, Andre, that was a great explanation. And I apologize for messing around with the slides while you were talking. I hope that wasn't too distracting.
No,
I was trying to hide my screen, but every time I went back, it just kept taking me back there. One thing I did want to add is, look, there's been an evolution. I mean, hedge advisory firms, one of the owners of MCT and I share the same birth year of 78. He'll talk about how one of the premier kind of hedge advisory firms that has morphed into kind of Compass Analytics and OBSS was started in the Bay Area, a company called Tuttle in 1978. And so, hedging has been around for a long time. That doesn't mean, however, that it doesn't evolve. So much like the best execution for loan sales, that's something that, has gotten more and more interesting. Oh, Casey, go ahead. Have you got a question for us, Casey?
We actually have a question from the chat, but I don't want to interrupt you.
Well, I'll just finish this point and then we'll come right back to it. But
okay.
What I was indicating is that, so we do this best execution analysis on the loan sale trade. Up until just a few years ago at MCT, if you walked out to our trade desk, you would see Andre and his team just furiously making phone calls like crazy, because a lot of the regional broker dealers and even primary broker dealers that we're trading those TBAs with were doing it over the phone. And so what MCT has done is we use a product called the Trade Option Manager, which actually puts your broker dealers in competition with one another, just like your investors. And so you can only make so many phone calls and get so many different bids from broker dealers. But what we've seen is, kind of again, wringing every bit of profitability out for the lender is being able to put competitive trades out to your broker dealers, and even including primary broker dealers. We sometimes see that the regional broker dealers have a stronger price. So what's nice about that is your best exiting, if you've got 3, 4, 5, 8, different broker dealers, and you've got 17 or 25 different investors, you're really electronic activity, this communication that's replacing the phone, you're really able to maximize the profit or minimize your costs on both sides of that. But yeah, Casey, go ahead. What question have you got from us? And thank you for the questions, everybody. Keep them coming.
So we have one from Tiffany Wright. She said, you may get to this, but she's always asked about the current investor appetite of the market and how that determines pricing. Also, what will be some basic indicators in the market that we may see some relief in the rates?
Yeah, Tiffany, we're moving to market trends and analysis here, and I think we recently had a client conference in San Diego, and we had the chief economist from the MBA out, and we're going to share some of those slides. I think investor appetite is really something that, again, I oversee our product and pricing team, and you can really just, the best, easiest way to see investor appetite is to look at their pricing. And it changes sometimes intraday, not only daily, but even intraday. So that's why it's important to have many investor outlets. And if I go back into the 2010, 11, 12, gosh, it might not be uncommon at all to just see 6 or 7 investors. Maybe that was the whole inventory of investors that you could execute a loan to. MCT has always encouraged their clients to build as many execution outlets as possible. And I think, Andre, you might correct me, but I know the number used to be at least 17 different investors, and that might mean 34 different executions because they might buy on a best efforts and a mandatory and even a bulk basis. So it could even be a multiple on that 17, but I think it's now even up into the 20s, even though we've had some, correspondents leave the space like Wells. You can definitely still see that diverse area. So we encourage you to have, kind of multiple broker dealers and then as many execution outlets as possible. And I think for the originators on the phone, I think originators are coming to expect to be able to see, hey, look, I know my company is investing in relationships that yield me the best originator price possible. And so seeing all these different execution types is very helpful. So Tiffany, I don't know if I answered that, but any questions, we're going to be sending out our contact information along with this recording. We welcome questions. Sometimes we are a little busy. It might take us a little bit to get back to you, but we'll absolutely get back to you. So the second part of Tiffany's question, though, is right where we're headed. And we have got way too many, great, look at all these slides. Come on, we got lots of slides here. But Andre, I think there was one, Tiffany was asking, about,
yes, let's talk about this one right here.
Yeah, There we go.
So this is actually an interesting slide. And if you read the headline here, you'll see that it's actually a bit antiquated. And just to show you how quickly the market is moving, this was taken, as Chris was mentioning, this was for, I believe, our exchange just a few weeks ago, towards the end of March, right?
Yep,
now, one of the most important, or I say, inflection points, if you will, was the market trying to factor in when is the Fed going to announce their first rate cut, right? Now, we've been trying to forecast this for over a year. I was on a webinar back in February of last year, and I was expecting the Fed to potentially cut last year, right? I think a lot of us thought that the economy would be in a recession. I'm still in the boat that we've been in a rolling recession, but that's a conversation for another day. The mortgage industry is clearly in a recession, as is the tech sector, but the job market's been so strong, right? So that's really what's been keeping us out of a full-fledged recession. And what that keeps doing is it's pushing out the timetable as far as when the Fed is going to potentially start cutting rates. The reason why I'm bringing us to this slide right here is Fed to hold funds rate until Q2 2024. Well, we're in Q2, And I think a lot of us were in this boat, just like the bond market was. I think there was upwards, back in January, February, there was a 75% chance of a Fed cut in June, but that's all predicated upon jobs, 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 and inflation, right? And so as you see these economic indicators come out on a monthly basis, we have another huge market indicator coming out on Friday as far as the PCE, Personal Consumption Index. And that's one of the key metrics that the Fed pays very close, if not the most attention to, as it relates to how the consumer is performing and how inflation is becoming increasingly sticky. If we look at the job market number that came out a couple of weeks ago, looking at March numbers, as in non-farm payroll, it blew it out of the water. We were double than expectations, on top of CPI being a tenth or two hotter than expected. And so while the market thought that inflation was cooling, maybe the job market's cooling, complete opposite, right? As far as the most recent jobs numbers and inflation numbers. And that's why it's so important, right? Because the bond market, we're always trying to think way down the road. And unfortunately, I guess, it's just reality. The Fed is going to have to be very laser focused on what's happening right now. And they're going to have to see that those economic indicators suggest what we're all kind of hoping for in a weird kind of sense, right? And there's a reason why they call bond traders doomsday traders, right? Because typically, whenever things are going really bad in the world, and you think about the pandemic, that was the best time for us because rates were at the lowest they've ever been. So it's kind of a weird. I talk to other people in other industries, and they're like, Andre, why are you hoping for the economy to be in a recession? Why are you hoping for people to lose their jobs? I'm not hoping for people to lose their jobs, right? But it's just kind of a correlation you can see whenever things are tough or there's geopolitical conflict overseas. Typically, that's going to result in a flight to quality, meaning more people are going to be buying bonds. That's going to drive down rates, essentially. And then once you start getting the Fed involved, and they're essentially the backstop for the world economy, they're not going to let this economy fail. So that's what they did during the pandemic, through all the stimulus and dropping rates down to zero. They're probably not going to do that again, because if they were to do that, that would suggest that things are really, really bad. And I don't think any of us want to relive pandemic, right? 2020, 2021, even though it was really good for business, right? So this slide here, I know that was a drawn out explanation. Once that job numbers came out for non-farm payroll in April a couple of weeks ago, and the increased CPI number that shocked everybody, inflation is entrenched right now. It has come down, yes, but the Fed target is 2%. We're nowhere near that, right? It's a lot easier to go from 8 to 4 than it is from 4 to 2. So the bond market wasn't too happy about those numbers coming out. Friday will be another very key data-driven release. So everybody keep your eye out on Friday, because the market will definitely be reacting to that. As of now, the experts, right, and the bond market is projecting we're probably only going to see one cut this year and potentially no cuts, right? If the economy keeps clipping along at this pace right now and the job market stays relatively strong, the Fed's not going to really see the need to cut, even though all of us want them to in this particular industry. But unfortunately, I think we're getting a little too ahead of ourselves here, and we really have to continue looking at the data. You've heard from Fed Chief Powell, you've heard from the other voters as part of the FOMC. They've all had a very hawkish sentiment the last few weeks. And so I think they're trying to tell the markets just to cool, pump the brakes a little bit. We're going to be higher for longer. They've always said that to their credit. And I think now we're finally realizing, like, oof, yeah, it's going to be a grind here, for the rest of this year, most likely. Go ahead, Chris, you were saying something?
Yeah, Andre, I just wanted to reinforce how important, monitoring this all the time is, because it really does change. So this is from a presentation that Mike Fratantoni, who's the MBA's chief economist, who advises and talks to Fed Chair Powell on a regular basis. Former head of, I think Freddie or Fannie, I should remember which one, their chief economist. So the best minds are presenting something like this, and I just did the math. This was less than 4 weeks old, this slide. And so we've changed our predictions that much. And so now for myself, for example, and for a lot of the owners and leadership teams of lenders, we're trying to build our budgets. And, you know, we all got burned last year with an expectation from the MBA and Fannie Mae that frankly we would start to see rates trend down dramatically in Q4, and that never materialized. So if you're depending on, you know, where you are in the loan manufacturing process at a lender, I mean, these are tough times. And so we're working with our clients again. You know, making an extra $100 on a loan makes a big difference right now. Being able to use every bell and whistle to get your pricing out there to be as competitive as possible while still maintaining margin to keep the lights on. I mean, look, that's a real fundamental reality for a lot of the folks in our space. Now, there's also an opportunity for growth here, and we've seen it in our own client base where folks are able to, you know, acquire other lenders, build volume. So it's not all doom and gloom, but as long as we're on the doom and gloom, I think there was another one here that I liked on refinancing incentive, right? So Andrew, or I don't know if you want to jump into this, but basically what this graph is telling us is that one of the abilities that we're looking out here is there is a lot of pent up equity sitting in folks' mortgage, right? So this debt, even though homes have been increasing, you can see debt across the board is starting to increase. And so one of the opportunities, even though somebody like myself, you know, I've got a 30-year fixed at 2.99. Frankly, it should be lower, but I'm too lazy. And of all the people, it's like the shoe, the cobbler, you know, they're the only kids that have bad shoes, right? I should have refinanced probably more, but I have this pent up equity in my house that in my mind, I would never mess around, you know, doing a cash out refi because I have a 2.99%. But if I want to buy that electric Humvee that I'd love to buy right now, I'm going to be paying 6, 7, 8%. Or if I want to do a remodel or add an accessory dwelling unit, that cost to borrow has increased so much. Or your credit cards. I mean, my gosh, you know, I think I looked at, you know, my credit card was something like 25 or 26%. So folks, there may be this refinance opportunity where folks might be doing more cash out refis. I was looking at a client who originated something like, call it 250 loans last month. And I was surprised to see that 95 of those were cash out refis. I mean, think about that. That's a significant percentage. And that's not what we're seeing. We are seeing, Andre, you can comment on page 2. We are seeing an increase in some of this refinance activity for cash outs in particular. There's another slide in here, though.
33, Chris.
Is it 33? Yeah, of course.
Yeah,
I don't.
That's what I want to talk about. So Chris is kind of mentioning that lock-in effect, right? That lock-in effect. It's essentially showing that the vast majority of mortgages that have been originated the last few years, over 70% of borrowers have a rate of under 4%, right? So even though you have people that may want to move, maybe they're not happy with where they're living now, they don't want to give up their rate. I mean, to be able to borrow right now, it's 2.5 times more expensive, right? And that's real dollars. So home affordability is at an all-time low. I was actually watching CNBC just before we got on the horn here, and the CEO of Redfin came out and said that 40% of borrowers that they polled stated that they would not be able to afford their current home if they were to try and buy it right now, right? And so that's a metric of interest rates skyrocketing, which we're all aware of, on top of home prices continuing to increase because you have that whole supply and demand. There's not that much inventory. Now, while they're trying to build new houses, that's not keeping up with all the millennials and other first-time home buyers that want to get into the market, but it's just too expensive right now. And for all those baby boomers and other generations that are sitting on their houses, like myself, even if I wanted to move, I couldn't because I'm not going to give up my 2 3/8 note rate for a 7.5, right? So you have this.
Of course, everybody remember that Andre already made the California flight from San Diego out to Tennessee, so he was ahead of the game here. Yes. He beat all the rest of everybody, all of the mass exodus from California. So don't feel too bad for him.
No, No, definitely not. But I mean, it's this is important to visualize, right? Like this is kind of what we're all talking about. When are we going to see relief? You know, when are we going to start seeing more volume? It's going to be tough because you look at how many borrowers are already locked in right now, right? Now you're going to have those who are going to have to move for jobs or family or health or reasons like that. But the vast majority, I mean, this graph really tells it all. I mean, you got a lot of people that are not going to be moving anytime soon, which is essentially locking up all that inventory, right? So it's going to keep prices relatively high. Paige, you want to say something?
Well,
Oh,
I was
sorry,
going to
Chris.
say also on CNBC this morning, they released the March numbers, and the housing starts came in 8.8 versus an estimate of negative 1.1. So it is good. I mean, the inventory's out there. The average home price, to Andre's point about affordability, the average home price is now 430,700, which is dropped 2% month to month, but still it's pretty substantial average home price.
That was 435,000 nationally, is that right?
430,700 nationally.
430.
Yeah. And then the starts came in 693,000 versus the 649 expected. But the average starting rate, so builders are getting pressure. Some have even had to discount. A lot of them, Andre alluded to earlier, the builder forwards have been pretty popular, but also buy downs have been very popular. But the average starting rate is 5.75 with the buy downs for the new homes.
Yeah, the builders are an interesting phenomenon. I mean, one of the products that I oversee is something called our base rate generator, where builders are releasing their own rate sheet because they may not, well, there's some additional tools that we have that allow them to kind of bring in rates where there aren't market data by requesting quotes directly from their broker dealers if they securitize. But I had somebody asking me, gosh, Chris, I can't get a 4.5 and a 5 to populate on my rate sheet first thing in the morning because there's no market data. I said, you're originating 4.5 and 5%. What are you talking about? But it's that builder business. So I think, as we add units to new construction there, those rate cases do make them a little bit more affordable. I think, one of the other things, and it's hard to point to something specific about it, but you do have folks that are comfortable with refinances and understand that the market moves a lot. So folks that watch the market go from, an average of 3.5% or 7.5% down to 3.5 or 2.5%. They've gone through that refi, so they do understand that rates move. So you have a more savvy borrower. So I think somebody like me, if there were an opportunity to have a home, or somebody who's refied their property 2 or 3 times, they may in fact be willing to take a higher rate with the understanding that, look, rates are going to come down and I'm going to be able to refi. The problem is, as Andre alluded, can they even afford to do it? You may be willing to take a higher payment with a higher interest rate, knowing that, hey, yeah, maybe I'm going to lock in at 7%, but I think, in a couple of years, I'm going to fall down to 5% again, and that's more affordable. But I don't think there's a general consensus out there that anybody thinks the rates are going as low as they once were. So, but Casey, I think you had one more question, and I see we've done a terrible job of time management because we all love hearing ourselves talk here. But why don't why don't I stop sharing here? Again, we're going to distribute this. We're all going to be available for questions. But Casey, what did you have for us on a question there?
I don't think we had a question, but I missed Amy Creason's comment earlier. She had mentioned she wanted to agree with you on how technology advances, like those incorporated into MCT and agile trading technologies, facilitate complex analyses on both loans and forward sales. Additionally, the technologies ensure greater efficiencies in data accuracy in loan sales and trading, which saves time, minimizes errors, and helps with audit reviews. Old school phones, and Excel spreadsheets don't cut it anymore.
Oh, I'm so sorry, Casey. I didn't mean to cut
No,
you
you're
there,
good. The last bit said old school phones, trade tickets, and Excel spreadsheets don't cut it anymore.
But I mean, come on, that's all I know how to do. I'm old. I'm the old guy. I used to be the young gun. But look, hey, I see we've come to the end of our time here, and Amy, you're not old. No way. I don't buy it. But I just wanted to thank everybody here, and I hope we were able to give you a little bit. I mean, Andre provided some wonderful insight into what's going on into the market for those of you that already work in capital markets. But I just want to again compliment anybody who isn't, particularly originators, understanding that right now capital markets play such an instrumental role. And sometimes there's this perception that, oh my gosh, capital markets, they're going to hedge the company's making all this money on these loans. And gosh, are they holding that back? And the reality is that that's really not the case. I think what we really, you do need to look at is, there's a trade-off here. Your capital markets guys have to work with you to get the best pricing possible through investor relationships or through producing their own rate sheets, but they are also responsible for keeping the lender in business in a lot of ways right now. So working in concert to drive as much origination as possible, but maintain profitability is so much more important now than it's ever been before, and you have to work in concert. It's unfortunately like I got to work with Paige here, even though he's in sales and I'm in operations. Nick, I appreciate you saying you're fired up, because you know what? Even though we walked through some doom and gloom here, I am still fired up. And never forget that what all of us get to do each and every day is we get to show up at work and we get to help borrowers achieve the dream of home ownership. And that is something that is special to this country. And it's the American dream. And it is tough. And it challenges each and every one of us to use every dial and lever at our opportunity to continue making that opportunity possible. So thank you so much, Casey. Thank you so much, Caitlin. Thank you, all of you, for participating. And thank you to the Tennessee MBA for inviting MCT to participate today.
We loved having you guys. Thank you, Andre, Paige, Chris, and David. You guys were great. So I'm looking forward to looking through the whole deck as well. Does anyone have any questions before we head off? I know we're right on time, but if anyone has anything, just pop it in the chat. But it sounds like we had some good feedback, and hopefully we can have you guys on again to maybe have a deeper dive once we get kind of a consensus of how everyone felt, if we have any more in-depth questions. So I'll get with you guys on that. But if no one else has any more questions, thank you guys again. And I'll stay on for a little bit, but everyone have a great day, and thank you for joining.
Thank you all.
Thanks all.
Thanks, everybody. And yeah, Casey, any questions, you can just circulate them to us via email. We'll get back to you, but encourage everybody to reach out to us. We'll always have time for questions. Being part of this industry, it is a little corny what I just said there, but it's a reality. We get to participate in pretty much the most important financial decision and opportunity that folks have each and every day. So I'll sign off here, but let us know. Paige, go ahead,
Casey,
sir.
I just wanted to tell you, this is great. I think this is the third one of these y'all done, and have more on the horizon. So I think it's good you're doing this. As I mentioned to you, Tiffany, Minky, I mean, Tennessee mortgage bankers, they're one of the most active, especially the Nashville branch. And y'all do such a great job.
Thank you.
Yeah.
If you guys have any other ideas, shoot them at us. We're always open ears to new ideas and to have new people on. So we'd love to have more speakers.
All right.
Great.
Thank you guys. And
Thanks,
next
guys.
month or June, we'll have some down payment assistance programs for people still on here who are interested in that. So it's home ownership month. So we'll be hitting on that here soon.
Awesome.
All right.
Thank
Thanks,
you.
guys.
Casey, I'll just share with you, Amy Creason from that Capital W, they're working to bring, they're a great opportunity. If you haven't connected, I would suggest you guys do, for
Okay.
sure.
Yeah.
But thank you, everybody, so much. You all have a great day here. We'll get through this together.
All right. Thanks. Chris, just send me her information. Bye, guys.
Bye.